welcome back to another video with the House Money Investing channel. In tonight's video, we're going to be going over some stock picks I got for you for today. Some of these are new to the watch list and others are reoccurring stocks on the watch list. So let's get right into it. As you see here, the first stock we got is AT&T. This is something I'm heavily trading this month. It's probably about my fourth or fifth time putting this on the watch list. AT&T is a great dividend paying company as well as a long-term hold. I hold this long-term myself, plus I'm like I said, I'm heavily swing trading it this month. They're getting to the streaming service with Warner Brothers, the acquisition of Warner Brothers, so the streaming will bring them top line revenue, which will raise the stock, and you'll of course steady get that dividend payout. They also, have telecom service like internet, telephone, things of that nature. Then we have a Fidelity stock here. This is Fidelity National Information. Sorry, give me 1 second. This thing here has been performing pretty well. It doesn't fluctuate very much, but over the past year it is up 132%. It's a slow for sure gain. So over the past year it's only up 1%, but like I said, the past 5 years it's up over 132%. It does pay a 1% dividend yield, $87 billion market cap, and it's about $17 off of its yearly highs. Looking at 38 analyst ratings, you got a 79% buy rating. Basically, so the shift toward electric payments will continue to create room for acquirers to see growth without stealing share from one another. With healthy operation margins and limited reinvestment needs, FIS throws off a good amount of free cash flow and activity returns it to shareholders. The bank technology business is very stable, characterized by high amounts of recurring revenue and long-term contracts. They've been killing EPS here, and this is a banking company out of Florida. Fidelity National Information Services engages in the business of technology solutions and services for merchants, banks, and capital market businesses. It operates through the following segments: merchant, banking, and capital markets. The merchant segment is focused on serving merchants of all sizes globally, enabling them to accept electronic payments, including credit, debit, and prepaid payments originated at a physical point of sale, as well as in not present point of sale, such as e-commerce and mobile, basically. And the banking segment is focused on serving all sizes of financial institutions for core processing and application solutions, digital solutions, fraud, risk management, compliance solution, electronic fund transfer, and network services, payment, wealth and retirement, item processing, and output servicing solutions. The capital market segment is focused on serving global financial services clients with an array of buy and sell side solutions. This company's been out since 1968. So this will give you exposure to the banking segment of the market. And with the feds announcing the banking buyback, you can be assured that that's going to put pressure on these shares, and they're going to skyrocket. So it's going to be a little bit of a growth play this year in 2021, as well as a nice dividend payer. Then we have another Fidelity FNF. This is Fidelity National Financial. This thing here has been up over the past 3 months, 24%. Pays a nice dividend ratio of 3.40, great PE ratio of 11.41, $11 billion market cap, and it's about $10 off its highs. 6 analysts, 83% buy rating. They've been killing EPS since quarter 1 of 2020, so we're going to look forward to quarter 4 of 2020. This is an insurance company based out of Florida. They engage in the provision of title insurance and transaction services to real estate and mortgage industries. The service includes title insurance, escrow, and other title related services, including trust activities, trustee sales guarantees, recording and home warranty products and technology and transactional services to real estate and mortgage industries. The company operates through a couple segments: title, corporate. The title consists of operations of title insurance, underwriters, and related businesses. The corporate and other segments involve real estate brokerage businesses. This was founded way back in 1847. So this will give you some exposure to the insurance sector of the market. Great balance sheet for this company, and as of course, great fundamentals. Then here we have XLY. Whoa. This is a selector spider fund. So I love spider funds. As you know, if you watch my videos, this thing was up 27% in the last year. Dividend payout of 0.82%, $18 billion market cap. It's the nearest all-time highs. Basically tracks market weighted index of consumer discretionary stocks drawn from the S&P 500. So when it consists of the S&P 500 and things of that nature, you know, it's always going to be a good pick. That's the top 500 companies in the United States. So that's going to be a new swing trade for me myself. Then we got FBCG. This is a Fidelity blue chip growth stock. This has been up over 41% over the past year. It's a new IPO. It was just listed back in June. Very small dividend of 0.03%, but blue chips were looking for growth, right? Near the all-time highs. And this is basically it's actively managed, which is great, meaning they are going to buy and sell you know, in and out of companies all the time. They will charge you a management fee, which would be, you know, anything less than 1%. So the gains will kill that fee, so don't worry about that. Non-transparent fund of fundamental selected globally growth stocks. So basically your best blue chip growth stocks, which, you know, blue chips are like Amazon, Facebook, Microsoft, Google, things of that nature. And it's going to be, you know, the best blue chip growth stocks, the ones with the most growth potential, are going to be in this ETF by Fidelity. And Fidelity is a great resource to have a great team. Then we got EWZ. This is something I'm already into on the swing trade. And this is a Brazilian fund by iShares. I love iShares. And this will give you exposure to other markets besides the United States. So you want to try to get into like Japan, China, Canada, Africa, Brazil, Europe, etc. Sometimes it's kind of hard to pick individual companies. I mean, you got your standouts like, you know, Alibaba, ticker BABA, or NEO, ticker INO, or Baidu, things of that nature. But other than that, it's kind of difficult. So what I like to do is get ETFs and funds, which will give me something that's low volatility, also with plenty of diversification, but at the same time, it's going to give me exposure to other markets, and they're going to pay a nice dividend yield. This one here pays a 1.71 dividend yield. Next up, we got EWJ. Similar to the Brazil ETF, this one is related to Japan, so the same fundamentals apply. This one also pays a nice dividend, 1.04%. Then we got IBT. This is a Dow Jones U.S. Home Construction ETF presented by iShares. Dow Jones is a great fund. iShares is dope. And then you got the home construction side. If you know anything about stocks like Home Depot and do-it-yourselfers and, you know, the real estate market, home construction is always a booming business. They were up 25% last year, a dividend of 0.46%, a $2 billion market cap, and about $5 off of its yearly highs. And this basically tracks companies involved in the production and sale of materials used in home construction. The real estate market is booming. The prices jump, and you best believe materials are going to be bought. New homes are being built every day. Probably my favorite section of land or property that I've been looking at recently is in the Vegas area. They're really expanding out there. And then you got XHB. This is a home builders ETF presented by Spider. Very, very dependable fund as well. Up 26% in the last year. Paying a dividend of 0.73%. And they basically, it's an equal weighted index of U.S. companies involved in the home building industry. Pretty much similar to iShares, but this one's presented to you by Spider. Then we got Plug Power. This is something I'm long-term. I hold long-term. Something I continue to swing trade. I added it right back to the watch list. Me personally, I'm up 95.28% on Plug. The stock's sitting at $33. I got in at $17. Past year, it's up 957%. So see, I'm up 95%, and I was late to the party because it's up 957 in the past year. It ran up from $3, really $2.53, all the way up to $37.50. And I think, me personally, I think Plug Power is going to reach $50 by the end of 2022. So I'm looking to swing trade this thing and build up my position. 89% buy rating from 9 analysts. Killed EPS quarter 2, quarter 3. I got in this play back in October. I swing traded it in September, got in October. And this is a alternative energy technology with focus on the design, development, commercialization, and manufacture of hydrogen fuel cell systems used primarily for material handling and stationary power markets. They have fuel cell system solutions that are designed to replace lead acid batteries and electric material handling vehicles and industrial trucks for some distribution and manufacturing businesses. EV is a big play. Battery is a big play. Take a look at Plug. Outstanding stock. Then we got Wells Fargo, ticker WFC. This is something I hold long term, something I'm steady swing trading in. I'm currently up 19.59% on Wells Fargo. For the past 3 months, it's up 30.45%. Great dividend, 4.10%. Wells Fargo is another bank play like the other bank play I announced earlier. They're doing the share buybacks. The interest rates are going to go back up. People are going to be getting all kinds of loans, trying to make some money, in the real estate sector, opening businesses back up and things like that. It's going to be a lot of open market share and a lot of open abandoned places that have shut down that people are going to try to, they're going to try to put, infrastructure up and take over these buildings and make a profit. You best believe. Then we got Walgreens, WBA. This is in the healthcare sector. Walgreens is dominating. I'm up 10.11% in Robinhood. In Walgreens, up 13% over the last 3 months. It was beaten down due to the pandemic. But with the vaccination coming out, best believe it's a bounce back, guys. 4.70 dividend yield. So a nice solid dividend. $20 off the yearly highs. So it's got a lot of room to run up. And they're going to make a lot of money, with the vaccine as well as general health care, due to the pandemic and people worried about their health. People worried about health is at an all-time high. This has an 86% hold rating from 22 different analysts. Next, we have Bank of America, similar to Wells Fargo. Nice bounce back play. This is something I'm already holding long term. I'm steady swing trading it, added right back to the watch list. I'm currently up 4.95%, and this thing isn't even close to bouncing back yet. It's just getting started. Nice dividend yield of 2.40%, and about $6 off its yearly high as well. Again, with the share buybacks and all the world opening back up, the financial market's going to come back up, guys. It's going to come back up to at least where it was at and grow from there. So nice bounce back play. Then we got QTEC. This is a NASDAQ top 100 technology sector. NASDAQ is a very heavily tech fund. This will give you exposure to the top 100 companies in the NASDAQ related to tech. It's been up 36% over the past year. It does pay a small dividend of 0.44%. Like I said, it's going to be the largest NASDAQ technology stocks. Technology is on the wave. It's a new wave. It's a tsunami. All the tech plays have been booming this past year, and they're going to continue to boom. Technology is advancing forward year by year. It's getting crazier and crazier, and this is a very profitable fund from First Trust. Then we got ALXN. This is going to be a new play for me as well. This is in the pharmaceutical companies. You best believe they're going to make some money. They've been up 42% over the past year. PE ratio is 36%. It's decent. It's around the all-time highs as well. 61% buy rating from 23 analysts. EPS, they've been killing it since quarter 4 2019. This is a pharmaceutical company out of Massachusetts. It focuses on serving patients and devastating and ultra rare disorders through the development and commercialization of transformative therapeutical products. So basically, they have products for people with, severe illnesses like devastating disorders and things of that nature. So they have some commercialized products that are life transforming. So this thing here is gonna pop, especially if they get it right. Then we got NTAP, something I'm already swing trading. Added it right back to the stock to the watch list. It was up 6% last year. It fell drastically during the pandemic. It basically cut itself in half. But they do pay a 2.94 dividend yield. It's steady on the climb back up. It's almost reaching all-time highs again. 68% hold rating for this one. So basically, in line with NetApp's focus, cloud-based data management software may be one of the most important IT resources NetApp could develop into a crucial element of the multi-cloud ecosystem. Cloud-based data companies are huge right now, and this is another one straight out of California, Bay Area. So take a look at that, guys. Then we got good old Ralph Lauren. Everybody loves polo, right? I used to wear polo myself. Ralph Lauren's done pretty good over the past 3 months. It was beaten down, of course, due to the pandemic. It dropped from all the way down to $70 from like $130. It's ran back up to about $103, so it still has about $25 growth potential. Ralph Lauren has a great balance sheets, great business fundamental, very loyal customers. The buy and hold ratings are basically split, 50-50, and the gross margins are higher than those of competitors, and they've been improving. As a significant amount of merchandise achieves premium pricing, we expect Ralph Lauren's growth to come from controlled retail and e-commerce, allowing for the better command of overpricing and marketing. Since 2009, Ralph Lauren has reduced its wholesale business to 37% of revenue from 55% of revenue. Business tends to have improved for Ralph Lauren in Europe and Asia, which is as both regions have a higher unit retail, better growth prospects than the United States. So they're doing good over there in Europe and Asia. Their business revenue has grew from 37 to 55%, and they're killing their competitors, and they're keeping those price markets stiff. I think Ralph Lauren's going to continue to do well. It's a poppy trend. A lot of people mess with Ralph Lauren, so I'm going to give this one a go. Hopefully I can build a position in it off the swing trade, and this would be a company I love to get into. Then we got HWM. This is in the aerospace sector of the market. It's up 16% the past year. It's made up small dividend of 0.42%, over $12 billion market cap. It's near its all-time highs. 8 analysts got it 50% hold, 50% buy. We are in the early innings of the current aerospace upcycle. Significant aerospace exposure positions for this company continue to grow. Content will continue to increase on next generation aircraft and engine platforms. They'll pursue M&A, increasing its exposure to cutting-edge technology such as 3D printing. So basically, this is giving you exposure to industrials, materials, company out of Pennsylvania. It engages in manufacturing and engineering of lightweight metals. It operates through a few segments: engineered products, global road products, the E, P, and F segment. Produces basically, aerospace, industrial, commerce, transportation, power generated end markets. The GRP segment produces aluminum sheet and plate, aluminum extrude and metal machine parts, integrated aluminum structure systems, and agriculture exhaustions used in automotive, aerospace, building and construction, industrial packaging, and commercial transportation. This company's been around since 1888. So basically what they're doing is they have certain materials, lightweight materials like aluminum and other types of metals that can be used on, automobiles, airplanes, jets, rockets, all kinds of stuff. So it's going to be a nice little swing trade there. Then we got PHV. This is going to be a new play as well. This company's did bad over the past year due to the pandemic, but over the past 3 months, it's climbed back up 60%. Very small dividend yield of 0.08%, $6 billion market cap, still about $15 off the all-time highs, 95% buy rating. It has 2 brands which generate more than $18 billion in annual retail sales, have proven in strength in multiple regions with the potential of greater sales in China and Latin America. They have taken greater control of its brands through acquisitions, allowing improved marketing and pricing. PVH has issued debt and taken aggressive action to prevent liquidity during the COVID-19. We expect it to continue to generate free cash flow during and after the crisis. Tommy Hilfiger is known as a casual and active brand, which nicely aligns with the recent fashion trends. So this company, PVH, is one of their brands under their umbrella is Tommy Hilfiger. They have they do dress shirts, netwear, sportswear, jeanswear, infinite baby stuff for babies, swim products, handbags. They do footwear and other related products. They have like Calvin Klein, Tommy Hilfiger, and brands like that, and they sell all through North America, Europe, Asia, Brazil. They also have brands like NYC. So I'm pretty sure you're familiar with Calvin Klein and Tommy Hilfiger, 2 major brands. So this exposure to apparel and accessories market out of New York is going to be a nice play, along with the play that I just mentioned of Ralph Lauren. I think the game's about to come on. I got to watch my boy LeBron, so I need to kind of hurry up here, guys. Whoa. God, I lost my spot. Sorry about that. Oh, this is going to a story. What is heck? What's going on? Sorry about that. I lost track thinking about the Lakers playing. So quickly, we'll finish up here. I will be posting my dividend portfolio for the year. Well, for the dividends I made in December will be my next video. Then I'll purchase about 18 stocks later on and post that video. Okay, so we got FTNT. Last year, it's up 38%. Market cap over $24 billion. It's about $5 off of its highs. And this is related to cybersecurity, 63% holding. So basically, with no end to cybersecurity threats, their products should remain in high demand from the government entities, service providers, and enterprises. A growing enterprise customer base and technologies like software-defined networking and 5G create sizable revenue growth potential for Fortinet. Fortinet's consolidated cybersecurity platform could be enticing for customers attempting to decrease the quality of vendors which would drive more revenue per customers for Fortinet. They've been killing EPS since fourth quarter of 2019. Hardware company out of California, and it provides cybersecurity solutions to a variety of businesses such as enterprises, communication service providers, small businesses. It operates through network security, infrastructure security, cloud security, and endpoint protection, Internet of Things, and operation and technology. The network security segment includes a majority of product sales from ForGate network security appliances. The infrastructure security segment provides platform, which is an architectural approach that protects the entire digital attack services, including network core, endpoints, applications, data centers, and private and public clouds. Together with a network of fabric-ready partners, the Fortinet Security Fabric platform enables disparate security devices to work together as it's integrated. The endpoint protection, whoa, this guy won't quit texting me. The endpoint protection also works in the same way with remote offices, mobile workers, public cloud environments. A lot of techie stuff there. But basically, this is in cybersecurity. I own plenty of cybersecurity stocks. I love them. This is a booming market, and it's going to continue to boom with the crazy technology. So it's going to be a nice play there. Then we got Li Auto, something I'm already trading. Haven't had the best of luck with Li Auto, but I'm going to continue to swing trade it till I get it right, because I do think this is a good company. I like their fundamentals. This is a fairly new company, just IPO back in July. It is up still on the year by 87%. This thing ran up all the way to $47, dropped back down. So now, once it finds some kind of floor on it and get over that resistance, we should see it raising back up to 47%. So that's what I'm hoping. Some kind of bearish news is that Tesla cut prices in China, so it could be bad news for Li. But I'm not too worried about it. 78% hold from analysts. They killed EPS quarter 3, and this is the automotive EV play. They sell premium smart electric SUVs, energy vehicles. It provides safe, convenient, and cost-effective mobile solutions to families. The firm model includes Li One and EREV. The passenger vehicle market categorized into the sedan, SUV, and MPV segments. So a nice EV play here. And then we got another new stock pick, GELYY. This is also an EV play. Very slept on EV play, up 69%. Not a lot of people know about this one, guys. You want to jump in. Does pay a dividend of 0.94%. It's near the weekly highs. It's an EV company out of Hong Kong. Basically, it's an investment holding company which engages in the research, production, marketing, and sales of sedans and related automotive components. It operates through a few segments: People's Republic of China, Eastern Europe, Middle East, Africa, South and Central, and other countries. This company's been around since '73. Then we have good old MGM Resorts. I held this long term. I'm going to continue to swing trade it. This is a bounce back play. It's down on the year about 5%. Last 3 months it's up 50%. It's running back up. Nice dividend yield of 0.91%. This is a casino resort. People are going to travel. They're going to vacation. They're going to have a good time. MGM is a very famous arena for like boxing and things like that. Very famous resort. And you can best bet that this is going to be a nice bounce back play. Then we got MSTR, MicroStrategy. This thing is up 173% on the last year. Crazy PE ratio of 3,400. Super volatile stock, trading at an insane ratio. They've been good on EPS. It's a software company out of Virginia. It's a provision of enterprise of analytics and mobility software. It designs, develops, markets, and sells software platforms through licensing agreements and cloud-based subscriptions, related services. It's a flagship platform. It consists of analytics, Usher brands, things of that nature. So another cloud-based company here. Insane growth in the past year. It was like one of the top 5 or 10 growth companies over the last year. And then here for my personal picks, I got 3 top growth stocks to buy in January. We got Adobe, which is something I'm already holding long term. Something I will continue to swing trade. I'm currently up just 1%, but hey, I'll take it. It's going to continue to grow. Then we got good old PayPal. PayPal is going to be a nice growth stock. They're starting to sell Bitcoin, and trust me, they're going to make a lot of money off of Bitcoin, selling Bitcoin. I'm up 5.65% in this position, and this thing is going to continue to grow. PayPal and Square, they dominate the space that they're in. Then we have a new play, QRVO. This thing was up 41% last year, 65% buy ratings, and as a wireless technology shift to more advanced 5G network, smartphones will require greater RF content per device, which should provide a nice runway for further growth for this company. They have a variety of filters for 4G LTE enabled smartphones and infrastructure products that might be key components for emerging 5G networks. So basically, like if you got a phone that doesn't take 5G, they may have a product that can transfer your phone or adapt it from 4G to 5G. It's provision of core technologies and radio frequency solutions for mobile infrastructure and aerospace or defense applications. It supplies RF solutions that perform various functions in the increasingly complex cellular radio front end selection of smartphones and other cellular devices. The defense sector supports diverse global applications, including unique high-speed network connectivity to the cloud, data center communications, rapid internet connectivity through the home and workplace, and upgraded military capabilities across the globe. The firm productions include amplifiers, control products, transmitters, integrated circuits, filters, duplexers, frequency integrated modules, optical components, passives and switches. So a lot of techie stuff here. So that'll be my third growth stock I've been looking at, and just based off the technical charts that I've seen and the the balance sheets and of course the fundamental, it looks like a great growth stock. That'll be it for today's video. Like I said, I will post my next video with the amount of dividends I made in December. I'll give you the total amount, plus I'll display all the dividends. Then I'll be buying 18 stocks here tonight, and I will update you guys with that video as well. Thanks for tuning in.